Here's 8 key things you might want to consider. And yes, it is a good idea to consider these things before these low tax rates expire in the year 2025. Number 1, you can defer or postpone the taxes. Number 2, you could spend more money now versus later. Number 3, consider a Roth conversion. Number 4, make tax-free gifts to your loved ones now versus later. Number 5, consider a qualified charitable distribution, or what we call a QCD. Number 6, you can include charity at your death. You could leave as much as you want to a charity because they're a tax-free entity. Number 7, I like this one, purchase tax-free life insurance, and particularly if you're trying to pass on large sums of wealth and keep it out of the hands of nursing home and creditors, you can either have the adult children own the policy on you, or you can have some sort of irrevocable trust on it. And finally, number 8, what we're going to talk about right now is consider annuities and something called the exclusion ratio. So what I thought I would do in our remaining time, again, if you're just now joining us, some of the highest interest rates I've seen in 20 years are being offered by bank CDs, but I think more importantly, by what's called multi-year guaranteed annuities, something we offer at Tony Walker Financial and have very competitive rates. In fact, we have one company paying 6.15% guaranteed for 5 years. Now again, these rates can change between now and the time you watch this show. We are recording this show in November, but once you lock in the rates, whatever those rates are with these MYGAs, they are guaranteed for a set period of time. So let's just look at the effects of this. We've got 3 different examples, and all 3 of these examples, this person sold $800,000 worth of land, maybe inherited $800,000, sold a business. This is money they have after tax, okay? This is not a 401k, although you can use these products for 401k rollovers and IRAs. We're just talking about somebody that's got a bunch of money that's already been taxed and they don't know what to do with it. They want it safe and they want to earn a good rate of return and possibly do some tax planning, okay? If we just left this alone at the 6.15% interest rate, again, these rates can be adjusted between now and the time you see this show, but let's say they lock it in. At the end of 5 years, they would have approximately over $1,070,000. Now this is tax deferred, so if they didn't want to pay taxes on it, they could defer that interest and let it grow. You see, the problem with a CD, even if you can find a CD at 6% with after-tax money, that $800,000 is going to produce about $48,000 or $50,000 a year. Even if you don't take it out and you let it compound, you have to pay the tax on it now, which creates something called opportunity cost. With annuities, tax deferred, we don't have opportunity cost. You'll have to eventually pay the taxes. I'll show you how we deal with that in just a second. Here's a good example. What we did is we let it grow. We did a 10-year guaranteed annuity at 5.5%. We let it grow for 5 years, all right? And then between years 6 through 10, we had them send the interest. So in this example, person had the money. Maybe they said, hey, for 5 years, I don't need the money. Maybe they're going to still work or they have other sources of income. But in this case, they say, hey, beginning in year 6, I need some income from that tax-deferred annuity. In that case, we would be able to send them right at $57,000 a year for the next 5 years without even touching principal. Now, this is powerful, folks. We haven't even touched the principal here. Now you might say, well, Tony, I know, but what happens? Are these rates guaranteed past 10 years? No. But you say, but I want income for the rest of my life. Can I turn these kind of annuities into your beloved mailbox money? Yes, you can. So let's go over this again. So what we're going to do in this example, we're going to defer it 5 years. Okay, the $800,000 is deferred 5 years. Then beginning in year 6 and for the next 20 years, okay, so again, setting the stage, we have a tax-deferred annuity. The person does not need income for 5 years, but beginning in year 6, let's say they're getting into their 70s, they want to guarantee an income for 20 years, and they want to spend the principal and the interest, but they want to keep their taxes down. Remember, all of this tax-deferred interest has to be taxed. If they were just to surrender this annuity all in one fell swoop, there'd be a lot of taxes. So how do we take advantage of something called an exclusion ratio and minimize these taxes? Well, in this case, starting in year 6, we're going to send them about $5,300 per month guaranteed, either to them or their beneficiaries. It doesn't matter. In this example, it was guaranteed at $5,300 a month. Now, at the end of 20 years, there's no more money left. They don't care. They just want to use the money and enjoy it while they still can. But the exclusion ratio means that only $1,971 of that money each month is actually subject to taxes. You see, most investments don't let you do this. As you create all these gains, if you start taking out income, the money that comes out first, that's your interest, has to be fully taxable. With an after-tax annuity, if it's positioned properly and you're working with somebody that understands this, we can stretch those taxes out and lower the taxes, meaning more money in your pocket.
Thanks for watching. We hope you enjoyed that video. If you'd like, check out these other clips. And be sure to hit that like button and that subscribe button for more videos.